At today's field hearing, you will hear from Director Cordray and a panel of distinguished experts who will discuss the auto finance market. The Consumer Financial Protection Bureau, or the CFPB, is an independent federal agency whose mission is to help consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. My name is Ixta Martinez. I'm the Associate Director for External Affairs at the CFPB. Our audience today includes public officials, community leaders, advocates, industry representatives, and of course, consumers. We're especially pleased to have in the audience Director Dennis Bassett, the Director of Indiana's Department of Financial Institutions, as well as staff from that office. We also have with us staff members of the Office of the Indiana Attorney General, as well as congressional staff from the offices of Senator Joe Donnelly and Congressman Luke Messer. Finally, we are honored to be joined by Commissioner Lucy Tedesco and staff members from the CFPB's Canadian counterpart, the Financial Consumer Agency of Canada. Let me spend just a few minutes telling you what you can expect at today's field hearing. First, you'll hear from CFPB Director Cordray, who will provide remarks about the auto finance market. Then, Patrice Ficklin, CFPB Assistant Director for the Office of Fair Lending and Equal Opportunity, will lead a panel discussion on auto finance. Following the panel discussion, there will be an opportunity to hear from the public. Today's field hearing is being live streamed at consumerfinance.gov. You can follow CFPB on Twitter and Facebook. So let's get started. I'm very pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, he led the CFPB's enforcement office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you, Zixta. Thank you all for joining us today. And allow me also to join in recognizing the Honorable Lucy Tedesco, the Commissioner of the Finance Consumer Agency of Canada, who joined us today, as well as Director Bassett from the Indiana Department of Financial Institutions. We're here in Indianapolis to discuss a market that matters deeply, both to our everyday lives and to our nation's economy. That is the market for financing the sales of cars and trucks. Nearly 9 out of 10 Americans commute to work by automobile, and in vast areas of the country, including where I'm from, Ohio, ownership of a vehicle is almost essential to personal mobility. As for the economy, we all know that automotive manufacturing is a substantial driver of jobs, income, and growth in this country, especially here in the Midwest. The deep penetration of this industry in our economy is more than a century old, and the numbers are staggering. Almost 4 million people are employed in auto-related industries and aftermarket service businesses, typically at relatively high wages. Millions more rely on the automotive industry for their health care or collect pensions from prior work in the industry. 60 years ago, an industry executive made the famous statement before Congress that, quote, "For years I thought what was good for the country was good for General Motors and vice versa." His statement was exemplary of a widespread state of mind about our way of life in America. Jack Kerouac defined the Beat Generation with his classic work On the Road, which starts with bus travel but later steps up to a rickety Ford sedan. In The Grapes of Wrath, Steinbeck memorably sends the Joad family at a converted Hudson truck west from Oklahoma on Route 66 to seek a new life in California. And just think of our many iconic songs about our little cars, Little Deuce Coupe by the Beach Boys, some of you may recall that, those older in the crowd. Our big cars, Pink Cadillac by Bruce Springsteen, and our trucks, Roll On 18-Wheeler by Alabama. And of course, there was the British band Queen's emphatic anthem that spoke for many Americans called I'm in Love with My Car. Although the automotive industry has been through dramatic ups and downs in our lifetime, it's notable that in September 2014, the facts on the ground and the signs for our economy are quite good. 5 years after the fast-track bankruptcies of Chrysler and General Motors, I served as Ohio Attorney General during that rather whirlwind period. Automotive manufacturing is back, and the reborn industry is leading the economic recovery. And make no mistake about it, our view at the Consumer Financial Protection Bureau is that strong auto sales are good for consumers, good for producers, and good for the American economy. A different aspect of the broader market, and more of our focus today, is the financing of auto sales. As with many consumer financial markets, financing here is driven by two distinct historical dynamics. First, loans generated by the automakers themselves through their own finance companies to help move their product. And second, loans that banks and other lenders make to their customers to fund purchases of all kinds, including cars and trucks. The auto finance market is yet further complicated by financial mechanisms that have grown up around lease arrangements, which are increasingly common, and used by consumers instead of loans for many outright purchases. Our intense reliance on our cars and trucks is underscored by the fact that consumers often are willing to pay their auto loan before other types of consumer debt, like a credit card or a mortgage payment. This makes sense if people feel unable to do without their regular mode of transport, especially in vast areas of the country where mass transit is less common or convenient. It also explains how powerful the collateral can be on small dollar car title loans, though those are not our focus today. It is not surprising then that auto loan debt is the third largest source of consumer debt in America, exceeded only by mortgages and student loans. In fact, at the beginning of this year, American consumers had more than 87 million auto loans outstanding, valued at nearly $900 billion. Over time, the average loan for a new car has crept up to nearly $27,000, though it is also noteworthy that those cars are staying on the road longer. Given the significance and breadth of this market, it's critical that we keep a watchful eye on how consumers are being treated. Back in 1903, President Teddy Roosevelt gave a speech about his Square Deal, which included some of the country's earliest consumer protection legislation. The Rough Rider said, "Let the watchwords of all our people be the old familiar watchwords of honesty, decency, fair dealing, and common sense. We must see that each is given a square deal because he's entitled to no more and should receive no less." Those are watchwords we live by at the Consumer Bureau because honest businesses and America's consumers all deserve a fair financial marketplace. In order to understand the actual consumer experience, let us go back and understand how the market functions. Whether a consumer is financing an auto purchase or leasing a car, they have two main options. They can take out a loan or lease directly from a lender, such as a bank or auto finance company, or they can go through an intermediary to get a loan or lease from a third-party lender, which is known as indirect auto financing. Roughly 80% of consumers who obtain credit to finance their auto purchase use indirect financing and get their loan through an auto dealer. Banks and other financial institutions engage in both direct and indirect financing. While some non-bank auto finance companies engage in both direct and indirect auto lending, the so-called captive finance companies, owned by the automotive manufacturers themselves, focus on indirect financing. Many captives provide consumers with financing for the primary purpose of facilitating sales for their parent companies and associated dealers. Non-bank auto finance companies extend hundreds of billions of dollars in credit to American consumers, yet they have never been subject to any supervisory oversight at the federal level. These companies have also played a significant role in the growth of subprime auto lending by making loans to consumers with lower credit scores. In this market, as in others, subprime borrowers may be more vulnerable to predatory practices, so direct oversight of their lending practices is essential. Today, we're announcing a proposal to extend our supervisory oversight to larger non-bank auto lenders, including these captive lenders. This proposal is needed to level the playing field for banks and non-banks in the auto lending market. We already supervise the auto lending practices of banks with more than $10 billion in assets, and this step would extend our supervision to the larger non-bank companies as well. It should not matter whether you get a loan or a lease from a company that has a banking charter versus one that does not. Every auto lender should be following the law and be subject to the same level of oversight. This expansion of coverage is important to protect consumers, but it will also remove a distortion in the marketplace and is a matter of simple fairness to competitors who should play by the same rules in the same way. When consumers set out to bring home a car or a truck, the process can be uniquely complex as it encompasses many decisions. First, people have to pick out their choice of vehicle, the make, the model, the price, and its features. At some point, they may encounter certain add-on products such as a warranty, rust-proofing, roadside protection, service plans, and more. By the time they've made all these choices, they may be invested in the car, psychologically, and impatient to finish up and drive it home. Financing can come to seem like almost an afterthought or a mere detail, rather than a key product in its own right. Consumers may have very little sense of what financing options are available beyond the first deal described to them. We need to make sure that loans offered by auto finance companies are marketed honestly and fairly. Companies cannot use deceptive tactics to sell loans or leases. Consumers should not be lured into a deal by misleading statements about the benefits of the product they're being sold. And consumers should get clear and intelligible contracts centered on terms that they can understand. Once the deal is finalized and people are making payments on their loans, we want to make sure that the finance companies are providing accurate information to the credit bureaus. Over the summer, we took action against an auto finance company that distorted consumer credit records. For years, the company knew that it was sending incorrect information about tens of thousands of its own customers to the credit bureaus. That is against the law, and we will be vigilant to ensure that companies have processes in place to ensure they're reporting accurate information about their customers to the credit bureaus. When consumers fall behind on their loans, we have authority to ensure they're not subjected to unfair, deceptive, and abusive debt collection tactics. When auto loans reach a certain stage of delinquency, the finance company has the option to repossess the car. We've heard complaints that cars and trucks are being repossessed while people are current on the loan or have a payment arrangement in place. Consumers also complain about inaccurate deficiency balances following repossession. We're working to make sure that collectors are relying on accurate information and fair processes whenever they collect on debts or seek repossession. In all these areas, our proposal to assert supervisory authority over the larger non-bank auto financing companies would help us make sure that these companies are playing by the rules just like everyone else. Specifically, we're proposing to supervise non-bank auto finance companies that enter into or otherwise acquire 10,000 or more loans, leases, and/or loan refinances per year. We would cover about 90% of the non-bank auto finance market activity and bring more accountability for about 6.8 million consumers who obtain financing from these companies each year. In addition to all the matters just described that would fall within the orbit of our supervision, the extension of our oversight to the non-bank auto lending companies would also allow us to protect consumers better against the silent pickpocket of discrimination. As anyone could see and hear, the Bureau has long expressed concern about what we view as a serious problem. In March 2013, we issued a bulletin reminding indirect auto lenders that it is illegal under the Equal Credit Opportunity Act for a creditor to discriminate in any aspect of a credit transaction on prohibited bases such as race, religion, national origin, or sex. And that is so whether the discrimination is grounded on a claim of disparate treatment or a claim of disparate impact, as federal law has long provided. Simply put, discrimination hurts us all. Whether in our personal lives or through transactions in the financial marketplace, discrimination disadvantages people for reasons beyond their control, and it also hurts the larger economy by artificially distorting the marketplace. It is both wrong and economically inefficient. All consumers deserve an equal opportunity to access credit. In the auto lending market, we've expressed our concern that policies which allow dealers the discretion to mark up buy rates beyond an accurate assessment of a person's creditworthiness creates risks of discrimination that could impede equal access to credit. And in our supervisory experience, we have found that when an indirect lender has a policy allowing a dealer to use its discretion to mark up the loan without regard to the actual credit profile of the consumer, and often for financial reasons, to benefit from that markup, the risk of discrimination increases. Whether this is done openly and expressly on the one hand or silently and implicitly on the other hand does not change the fact that the consumer has been financially disadvantaged in violation of the law. Unbeknownst to the consumer, the discretion to charge distinctly different rates can dramatically increase the risk of unlawful discrimination. Discriminatory markups on auto loans may result in tens of millions of dollars in consumer harm each year. With the average loan for a new car nearing $27,000, even a slightly higher interest rate can cost consumers hundreds of dollars over the life of a loan. Where we have seen such discrimination, we've taken action through our enforcement and supervisory tools. Last December, we announced our determination that one of the nation's biggest indirect auto lenders, Ally Bank, had pricing practices that cost about 235,000 minority consumers many millions of dollars. In the largest resolution ever in an auto loan discrimination case, we worked with the Department of Justice, our strong partner, to obtain $80 million in remediation for these consumers. Ally also had to pay $18 million in penalties for its actions. Other matters may result in further enforcement actions as the work and investigations we do in tandem with the Justice Department remain ongoing. We've also taken action against auto lenders through our supervision program. Today, we're publishing a new Supervisory Highlights report, which describes our efforts to combat discriminatory auto lending practices at other banks we supervise. Here again, we've found that their discretionary markup practices have created greater risks of fair lending violations, and in fact, we've found that some of these practices have resulted in discrimination against African American, Hispanic, and Asian and Pacific Islander borrowers. This is not a minor matter. In total, these supervisory actions have led to $56 million in additional relief to 190,000 further consumers so far, nearly approaching the scope of relief provided in the enforcement action against Ally. In these cases, minority borrowers were paying more for their loans than similarly situated non-Hispanic white borrowers. Such discrimination is wrong and deeply unfair to consumers, and we will continue to be aggressive about rooting it out of the market. We are pressing auto lenders to conduct more of their own internal monitoring to prevent and remedy discrimination. Notably, our recent supervision work has revealed that some lenders have done a much better job of managing their compliance programs and have been able to limit the size of the disparities in their loan portfolios. We have previously suggested that one way to accomplish this result is to eliminate dealer discretion to mark up interest rates, which some lenders are doing, while finding other ways to compensate dealers appropriately for the work they do to secure new loans. Another more intrusive way to proceed is by developing and implementing more intensive compliance management systems that inevitably involve lenders more directly in evaluating and correcting the practices of their dealer networks, as embodied in the Ally enforcement action. In our latest report, we also note that some companies have sharply reduced, but not eliminated, dealer discretion, which has reduced the size of disparities and may allow a solution that does not require dealer-specific monitoring and corrective action. We remain open to discussing these approaches or any others that appropriately address the risks of discrimination in auto lending. Finally, we're responding today to what we've heard about the need for more transparency by publishing a white paper that provides greater detail about the mechanics of our approach to these issues and offers new research into the statistical validity of this approach. In order for us to evaluate whether a lender is following fair lending laws, we need to know to whom the lender is extending credit. Auto and other non-mortgage lenders are not generally allowed to collect demographic information. Since they do not collect this data, our fellow regulators and we have developed proxy methodologies to model this information as accurately as possible. As we indicate in our white paper, the Consumer Bureau's Office of Research, working in close collaboration with our exam teams, uses a statistical approach similar to methods used by other federal financial regulatory agencies and the Justice Department. In order to estimate consumers' race and national origin, our researchers use borrowers' last names and place of residence. Census Bureau data allows us to calculate the probability that an individual belongs to a particular race and ethnicity based on their last name and the demographics of the area where they live. By considering these factors together instead of separately, we're able to more accurately assess which consumers are getting which loans and to spot discriminatory lending practice patterns. Much of this approach is fairly well known in the financial industry, which already engages in similar modeling to gauge its own fair lending risk, not only for regulatory purposes, but also to manage the risks of private litigation. But to ensure that lenders can replicate our methodology, we are releasing in an open source format the computer code we use to calculate these probabilities. To echo President Roosevelt, consumers deserve a square deal based on fair dealing. We are working to ensure that all consumers can have equal access to financial opportunities. Cars and trucks can help people drive toward economic success. Maybe it can take them to a new job or a new town. Or maybe the goal is to save commuting time so they can work longer or have more time with their families. Millions of American families buy cars and trucks every year. More than 15 million last year, I'm glad to say. For all these reasons and more. It's important that the financing of these products does not come at an unjustifiably high cost. The Consumer Bureau will continue to work to ensure that people can get fair access to credit on terms that reflect their actual credit worthiness, that marketing is honest and factual, that the terms of the deal can be made plain and readily understood, that companies are not furnishing wrong information about their customers, and that people are treated with respect and dignity in the debt collection process. As President Roosevelt framed the issue, each of us is entitled to no more and should receive no less. And particularly when it comes to discrimination, we will insist that this must be so in accordance with federal law. Everyone must be treated fairly. Thank you.
Thank you, Director Cordray. At this time, I'd like to invite all the panelists to take the stage. And while they are doing so, I'll briefly introduce the CFPB staff and guest panelists who will participate in today's discussion. Patrice Ficklin, the CFPB's Assistant Director for the Office of Fair Lending and Equal Opportunity, will facilitate today's discussion. She will be joined by the CFPB's Deputy Director and Associate Director for Supervision, Fair Lending, and Enforcement, Steve Antonakis, as well as David Silberman, the CFPB's Associate Director for the Office of Research, Markets, and Regulations. Guest panelists include Chris Kukla, Senior Vice President, Center for Responsible Lending, Crystal Radcliffe, Indianapolis Branch President of the NAACP, Andrew Alt, Staff Attorney with the Indiana Legal Services, Steve Zeisel, Executive Vice President and General Counsel with the Consumer Bankers Association, Paul Mitri, Chief Regulatory Counsel with the National Association of Automobile Dealers, and Bill Himpler, Executive Vice President with the American Financial Services Association. Patrice, you have the floor.
Thank you, Zixta. Get this microphone adjusted. We're very cozy up here. And thanks to all of you for joining us today to discuss the Bureau's announcements and your experiences with the auto finance market. Our mission is to make markets for consumer financial products and services work for Americans. We have also been charged by Congress to ensure fair, equitable, and non-discriminatory access to credit for both individuals and communities. I'm honored to be joined on this panel by colleagues from across the Bureau, with whom my office, the Office of Fair Lending and Equal Opportunity, works very closely in pursuit of those objectives. I also am honored to have this distinguished panel join us. Today we focus on the auto finance market. As Director Cordray highlighted in his remarks, the significance of this market to consumers ranks third only to mortgages and student loans. We know that more than $500 billion in auto finance originations were made in 2013. For most consumers, borrowing money to buy a car is far more common experience than borrowing money to buy a home or pay educational expenses. Our announcements today mark further advances in the Bureau's work to protect consumers from unfair and discriminatory practices in auto finance. We propose to bring the larger participants in the non-bank auto finance market under our supervisory authority. As many of you are aware, our supervisory authority represents a powerful tool to ensure that lenders comply with the consumer protection laws under the Bureau's jurisdiction. Indeed, our release of a special edition of Supervisory Highlights devoted to our supervisory work with bank auto lenders underscores the significance of our supervisory authority, as we detail the work that our exam teams have done in identifying discrimination in pricing and securing lender commitments to pay approximately $56 million in damages to provide redress to up to 190,000 consumers. Finally, we also released a white paper on a key tool that the Bureau uses to identify discriminatory practices when self-reported demographic data are unavailable, our proxy methodology. It is our expectation that this white paper will broaden awareness of recent enhancements to proxy methodologies that have yielded significant gains in accuracy. With that brief introduction, I'd like to turn it over to our panelists and ask that each of them offer 3 minutes of remarks. Once they have delivered their remarks, our Bureau panel will ask a few questions to facilitate discussion among the panelists. Let's begin with Chris Kukla from the Center for Responsible Lending.
Thank you, Patrice. And thank you, Director Cordray, and the rest of the staff at the CFPB for holding this hearing, and thank you for giving us the opportunity to participate. For most families, the purchase of a car is the largest that they will make outside of buying a home. Owning a car gives families greater access to employment and increases their quality of life. According to a study from the Brookings Institution, the typical metropolitan resident can reach only about 30% of the jobs in their metro area using public transit, and that's assuming a trip of 90 minutes or less each way. It's no wonder then that TransUnion found that consumers made paying their auto loan their top priority, even ahead of paying their rent or their mortgage payment. Cars are vital to American families because for most, keeping a car and keeping a job are inextricably linked. In light of this fact, we can conclude that auto finance done well expands access to economic opportunity and can sustain it. The recent rise in auto lending, particularly in the subprime space, has attracted significant and ongoing attention in the media and elsewhere. Many of these articles have focused on abuses that occur in this market. Unfortunately, most of these abuses are not new. They've existed for some time. For instance, over the past 2 decades, the practice of lenders allowing dealers to mark up the interest rate for compensation has been the subject of regulatory scrutiny and lawsuits over potential racial and ethnic discrimination. Despite significant evidence that this discretion often leads to discriminatory impact, the practice continues. Lenders rely heavily on dealers to provide the pipeline for loans. Of the cars financed in the U.S., around 80% are financed through the dealer. As such, lenders and dealers share responsibility for abusive lending practices. Lenders set the terms for the loans they'll accept and provide the pricing discretion to dealers that has led to significant harm. We have learned, though, that in the recent increase in auto lending, lenders have also relaxed their underwriting standards. Loan terms are increasing as are loan-to-value ratios. This data can be an indicator of larger issues in the market, and in particular, whether these loans are truly affordable. As we learned from the mortgage market, when financial institutions rely heavily on third parties to generate loans, competition can shift from providing the best loan to the consumer to providing the loan with the least amount of underwriting restrictions and the largest compensation available. The mortgage market would have benefited from common sense rules to ensure loans were affordable and sustainable. Unfortunately, we did not act until it was too late for many homeowners and lenders, but we can avoid the same mistake in this market. The regulatory patchwork covering auto finance contributes to the endurance of these abuses, and consumer protection has for far too long been an afterthought. Congress chose to split regulatory responsibility over consumer protection and auto finance, separating dealers and lenders between different regulators. Nonetheless, we believe that regulators can and should exercise appropriate oversight of those entities under their jurisdiction. The larger participant rule is a welcome step in the right direction. Auto lending is a fractured market with a wide spectrum of players. The rule as proposed would bring many of those lenders under the same consumer protection umbrella. It's also important to note that while dealers and lenders have to follow the basic rules that all lenders must follow, there are very few consumer protections specific to auto lending on the federal or state level. And those that do exist frequently fail to protect consumers against the abuses they're purported to stop. Abusive and unfair practices, like the significant pricing disparities that dealer interest rate markups create, need to end. We believe that a robust car lending market is important to American families and the American economy. In particular, making loans to those with blemished credit or thin credit files can be helpful. However, the current market requires safeguards to ensure that the market is robust and sustainable. Consumers should trust that the auto lending market is transparent and fair. Abusive lending practices eliminate that confidence and have no place in our credit markets. We welcome the opportunity to be here today, and we look forward to the rest of the discussion. Thank you.
Crystal?
Thank you, and thanks for having us here today. The Indianapolis branch is seeing a high rise in predatory lending with a lot of the people that come through the college, through the college campuses, as well as low-income families. One thing that we've looked at is that when somebody goes for a loan, a lot of times they're looking for, when it comes to, let's say, females, they're actually looking for security, a car with a secured system. Well, sometimes as a low-income family, they she cannot afford to get one of the cars that she's presently looking at as a new car. So that takes her to a used car, which we know then is going to be a higher rate for her to secure a car. If she's late on that payment, let's say a child gets sick and she has to pay a hospital bill, then once again you're looking at a lending practice that they're going to pay more. They might go up from 8% to even 13%. So we're seeing a lot of trends like that coming through from our single families. We're also seeing a lot of our seniors coming in that are trying to get car loans because they can no longer have, as we were told, like bus transportation, because we know the system has changed. So we have a lot of high predatory lending with our seniors that are looking for cars. We also have a lot of our people who have retired from the automobile industry, knowing that what people have gone through, that are actually having problems themselves getting car loans. I know even myself as a UAW worker, I went to obtain a car and they did not even have me in the system. So through that it took me over 2 months to obtain a new car. So I know there's a lot of things out here that we could talk about as far as when we actually look at the verbiage of the predatory lending, but we're talking about everyday people. We're looking at people that don't have the opportunity to actually get out and have better credit. Now I know also we were looking at, when we were talking about our college students, we have a lot of college students that are going out getting loans because people are soliciting them because they are first-time buyers. So when they go and get these loans, what happens is they get a loan, their parents don't know they have a loan, they come in with this new car, and then all of a sudden the parents are responsible for taking care of the loans. Once again, that's putting somebody in another higher bracket of paying for an auto loan. So when you start looking at predatory lending, you have to look at who all's engaged in this through our community. But I know that we get a lot of things in also through some of our different partners that they were talking about, that they have people that come in and their loans are like, let me see, you put it in a little better fashion, a mid-grade if they were able to get it through a third-party lender versus getting it through the dealership. What we found is in some of the areas that people live in, that these particular car dealerships are where a lot of the people go to get these loans. I'm not going to call any names, but when those people get there, they get loans that are definitely in anywhere from 13% or higher. And the reason why that happens is because they have to go to these particular car dealerships to get the loans. So regardless of what kind of car it is, if it's a new car or if it's a used car, these are the lots that they're using to get these cars. So there's a lot of people that we know out there that are being targeted. And once again, like I said, you even have your people that have lost jobs that are still in the same situation as middle-class citizens trying to obtain these loans that are being put in the same situation as people that are been in low-income families for a while.
Thank you, Crystal. I neglected to introduce you, Crystal Ratcliffe of the Indianapolis branch of the NAACP. Now we'll hear from Andrew Alt, Staff Attorney, Indiana Legal Services.
Thank you. That's all right. In representing car customers, I've found that the impact on the auto financing has on other parts of consumers' lives is immense, particularly if the consumer's put into a bad financing deal. A bad financing deal means that the consumer may not be able to pay other bills, such as a mortgage or other essential expenses like utilities. Further, bad financing deals often lead to a repossession of the vehicle, and for most consumers, this is a major life-changing event. For the consumer, there are serious consequences to a repossession that is predicated upon bad financing. First, the consumer is often left penniless. Consumers routinely put down all of their cash reserves to make a large down payment. Oftentimes, this money comes from tax refunds or any other cash that the consumer can come up with. If the car is repossessed after a bad financing deal, that money is rarely, if ever, returned after repossession, even if the customer has had the car for only a few weeks. Second, a repossession caused by bad financing usually leaves the customer wholly without transportation. Most consumers have only one car for themselves, and so at the time of a purchase, and in addition to making a large cash down payment, many, if not most, deals involve a trade-in of the consumer's only other prior car. That trade-in is swiftly sold by the dealer, so if the new car is repossessed, the old car cannot be recovered. So if a buyer enters into a bad financing deal, in the end, they are generally left completely penniless and without a prospect for necessary transportation. What this means is that in addition to losing cash and credit, the consumer could also lose their job. And for example, if they're in college, maybe a semester in college. Under either of those scenarios, the customer stands to lose thousands upon thousands more dollars in lost wages and non-refundable student loans. That's on top of the thousands in down payment and vehicle value that was already lost due to repossession, predicated upon bad financing. Public transportation is usually not a viable option. Public transportation's reach is very limited here in Indianapolis and in many other parts of the country. It cannot be used for all of a person's needs. Repossession predicated upon bad financing can impact a person's ability to regularly see their doctor, affecting health and earning capacity, the ability to have child visitation, go to the store, and it just affects every aspect of consumers' financial life. Consumers are aware that their vehicle is critical to their well-being. So if they're in a bad financing deal, be it overpriced or on other bad terms, that they didn't really know what they were signing up for or thought they were signing up for, they're choosing to put off mortgage payments and other essential payments to make sure that they can still maintain their earning capacity by having a vehicle to go to their job. By doing so, they risk foreclosure, bankruptcy, utility shutoffs, and other negative financial consequences. And finally, dealer-arranged financing puts a major hit on a person's credit. When a consumer consents to have his credit pulled for dealer-arranged financing, they're not aware of the number of companies that will see their credit. And for each company that does see the credit report, it lowers the credit score of the person whose report is viewed. If after that, poor financing leads to repossession, their credit may not be good enough to secure another car loan. So in conclusion, auto financing is a critical part of most Americans' lives. Poor financing and repossession are major life disruptors. Anything that can be done to increase transparency and fairness in the auto lending market is a hugely positive development. Thank you.
Thank you. Now we'll hear from Bill Hempler, Executive Vice President, Federal Government Relations of the American Financial Services Association.
I'd also like to join Chris in thanking the CFPB for inviting AFSA and its members to join in today's discussions. We think this is very important. Let me say at the outset and make very clear that AFSA and its member companies do not tolerate discrimination. It hurts businesses, it hurts the economy, and most importantly, it hurts consumers. And after all, the vehicle financing industry is all about customer service. We stand shoulder to shoulder with the Bureau in our commitment to ensuring that consumers are treated fairly and have the best possible buying experience they can. We welcome the opportunity to dialogue with the CFPB because we continue to have concerns about the Bureau's vehicle finance guidance and the white paper that it was released yesterday. I must admit, though, that I am a little disappointed. The Bureau goes to great lengths to protect the transparency of the agency, and yet there were some panelists that did not receive either of these documents until we arrived here in Indianapolis, and yet at the same time the media had it and asked us for comments. This is a very important issue, and I would encourage the Bureau to continue its young history of transparency, especially in this area. I think we'd have a more robust discussion. Now, back to the white paper. Now, it does provide a technical explanation as to how the CFPB calculates its proxy methodology, and that's a huge step in the right direction, and we commend the Bureau for doing that. However, it has taken the CFPB 16 months to reveal how it calculates BISG, or its proxy methodology. In addition, we're concerned that the white paper does not describe how it estimates disparities, leaving more to be said on this subject. The white paper does confirm that BISG, or the proxy methodology used by the CFPB, overestimates the number of minorities in a lender's portfolio, but does not mention how the CFPB plans to account for that. AFSA has undertaken an extensive study to deliver later this fall with respect to the BISG methodology, and we believe that the study will show that the CFPB's reliance on BISG methodology skews the results. As it will also show, hopefully, as has been reported in many media outlets, that the automotive industry remains strong, continues to get stronger following the crisis in 2008. It's competitive, very, very fragmented, thousands of players, and it's an integral part of the American economy. Most importantly, we think our study will show that the auto finance industry is focused on providing the most positive experience for the consumer. We also have concerns with respect to the white paper in that it does not consider the economic impact of altering the vehicle finance market, such as flat fees that the director mentioned in his opening remarks. Take this one solution that was provided by the Bureau as an example that we think that the Bureau has not fully thought out this one particular solution, and we look forward to working and dialoguing with the Bureau on that particular solution. We know quite simply that flat fees would increase the cost of credit for consumers. Those on the margins would be hurt the most. They'd either be forced into higher priced financing, lower priced cars, or be forced out of the market altogether. Further, the proposed solution for flat fees, from our perspective, does not solve the discrimination problem that the Bureau alleges. My friend Paul Mitri and the auto dealers have put forward a legitimate solution that has won some favorable comments from the Justice Department. And we think the proposal that they've put forward is consistent with our lending members' comprehensive credit compliance efforts. We also remain somewhat baffled as to how the CFPB can find disparity at the portfolio level if no disparities exist at the retail level. Now, I'd be remiss if I did not mention the larger participant rule that the Bureau came out with. We remain concerned that the Bureau continues to issue larger participant rules that capture market participants that, for lack of a better word, are not large by any stretch of the imagination. Many of the market players that will be subject to the new rule have well below 1% of market share. According to Experian, the top 30 lenders in this space have less than 0.5% of the mortgage market, or I'm sorry, the auto finance market. Above all, the vehicle finance industry wants to comply with the law and regulations that are set forth by the Bureau, as well as continue to play a positive role in our American consumer experience. As an industry representative, we stand ready to work with the CFPB to develop workable regulations that protect consumers and simultaneously ensure that the American public has access to safe and affordable credit. Thank you.
Thank you. Next, we'll hear from Paul Mitri, Chief Regulatory Counsel, Financial Services, Privacy and Tax, National Association of Automobile Dealers.
Thank you, Patrice, and thank you, Director Cordray, and all your colleagues at the Bureau for the opportunity to participate in today's field hearing. As we have stated on numerous occasions and will continue to state emphatically, the National Automobile Dealers Association strongly opposes discrimination in any form and fully supports the efforts of the CFPB, the Department of Justice, the Federal Trade Commission, and other federal agencies to eliminate it from the marketplace. Our commitment to this goal extends well beyond statements. In January of this year, NADA, along with the American International Automobile Dealers Association and the National Association of Minority Auto Dealers, NAMAD, released to each organization's members the NADA Fair Credit Compliance Policy and Program. This publication provides a comprehensive framework that a dealer can adopt to ensure its pricing of consumer credit fully addresses fair credit risk while preserving the overwhelming consumer benefits that result when the dealer has the flexibility to discount its rates to earn its customers' business. Our program fully adopts and indeed adds to the very well thought out fair credit risk mitigation model that the Department of Justice developed in 2007 to resolve fair credit cases involving 2 auto dealerships. Of course, the NADA program, as with any compliance mechanism that is designed to address fair credit risk at the retail level, can only be effective if finance sources are encouraged, not discouraged, to incorporate such a program into their compliance management system. However, regrettably, this is not happening today. And a central reason it is not happening is because the CFPB has insisted that it is not sufficient for a finance source to implement a compliance program that is entirely effective at safeguarding against the possibility of credit discrimination at the retail level if, in the aggregate, there remains an apparent pricing disparity at the portfolio level. The Bureau's position is regrettable for 2 reasons. First, it serves no public policy purpose. Indirect vehicle financing transactions consist solely of secondary market sales from retailers who are independent of the finance source and who, as with other retailers, establish their retail margins based on local cost and competition considerations. If these businesses price consumer credit in a consistent manner for all of their customers, regardless of their background, then any aggregate pricing disparity that exists at the portfolio level as a result of these different retail margins reflects nothing more than a fully functional and competitive marketplace. It does not reflect an injury to consumers. Second, by maintaining that retail level compliance mechanisms fail to address finance source responsibilities at the portfolio level, the Bureau is missing a golden opportunity to encourage the adoption of programs that address fair credit risk where consumers obtain their financing at the retail level. Despite these concerns, our collective focus moving forward should be on solutions. This is why NADA created its Fair Credit Compliance Program, and this is also why we remain hopeful that the Bureau, in close coordination with the federal agencies that Congress entrusted with oversight over dealers, will work with key stakeholders to identify an approach to fair credit compliance that is both meaningful and viable, and that preserves robust competition in the marketplace. Thank you.
Thank you. Last, we'll have Stephen Zeisel, Executive Vice President, General Counsel, Consumer Bankers Association.
Thanks, Patrice. Thank you for inviting me to speak on behalf of the Consumer Bankers Association today, and for holding this hearing, which I think is incredibly useful for everybody, and I really appreciate the effort you put into holding this. And thank you for giving me the last word also, which is a nice luxury there. First, let me say Consumer Bankers Association, CBA, is a national trade association representing the interests of America's retail banks. We have active committees working on issues including auto finance and fair and responsible banking, and I'm pleased to be able to share the views of our members today. CBA member financial institutions are 100% committed to fair lending and responsible banking. We believe we have a strong track record in that regard. Our performance has reflected a commitment to compliance and a strong belief in the importance of fair and responsible banking. In fact, CBA has long been a supporter of the CFPB's non-bank supervisory authority, Section 1024 of the Dodd-Frank Act, in part for that very reason. Consumers should expect similar standards to apply to both bank and non-bank lenders. There's no reason people should be given different treatment based on charter differences that mean nothing to them. We strongly believe CFPB should hold bank and non-bank lenders to the same level of accountability for similar products and services. And that's why we're pleased to see the CFPB proposal to supervise larger non-bank financial services companies in the indirect auto lending arena. What we will be looking for are indications, as we look at the proposal and develop our comments, are indications that the Bureau will hold similarly situated non-bank auto lenders to the same standards that it applies to bank indirect auto lenders. Now in that regard, as to what those standards are, when the CFPB issued the Indirect Auto Bulletin back in March of 2013, it raised some concerns in the industry. As I said, I think banks felt pretty confident about their compliance process to date, but the bulletin definitely raised new questions about how the CFPB intended to tackle some of those compliance issues and some of the more challenging aspects of fair lending compliance in an indirect auto space, and what it would expect of the lenders that it supervised. We were also concerned that the bulletin raised expectations for compliance and enforcement, but had not been issued as a regulation, and therefore was not a rule, and it didn't have notice and comment, an opportunity for public comment and input from all parties, which I think, given the complexity and the difficulty of the issues involved, would have been warranted. It also, as a result, did not apply, or did not appear at least to apply equally to all lenders across the board at the time, obviously the non-bank lenders, but also other lenders of banks of different sizes below the CFPB's threshold. The challenges in this area are many because the indirect lender is really a secondary market for loans made by independent dealers. As has been said, the lender doesn't deal directly with the consumers and does not know their race or ethnicity, so they have to rely on these proxies for protected classes when they do their reviews and monitoring in anticipation of any compliance expectations. Yet the lenders being held accountable for statistical outcomes, in some cases in the portfolio level, on loans acquired from hundreds or in some cases even thousands of dealers, independent dealers, and for monitoring dealer behavior based on sometimes a limited subset of the dealer's loans that the lender actually acquires. We are very pleased, by the way, to see the proxy methodology white paper come out. This is something we've been asking for a long time, is to get some clarity around that issue so that the banks, that CBA member banks and others can know kind of what those expectations are so that they can be fully compliant with the law, which is what they are trying to do in this case. The indirect auto lending market has been beneficial to consumers. Dealers, as you have said before, are entitled to fair compensation for their efforts, and we want to make sure that whatever happens doesn't undermine a strong and effective sector of the economy. We have discussed industry concerns before with you and with the CFPB, and we're pleased to do so again. Thank you for allowing us to be part of this conversation.
Thank you. I'd like to kick off our discussion portion of this panel by asking a question of Steve and Bill. What aspects of the auto financing market distinguish it from other markets that the Bureau supervises?
Let me just start and then I'll pass it on to Bill. I mean, obviously, as we've said, the auto finance market is unusual in a number of respects, aside from its, its vibrancy. It is a third-party relationship. and the bank's not the originator of the loan. The dealer is the originator, and what we're calling the lender here is the assignee in a sense, purchases a retail installment sales contract. So in acquiring the finished product, they're getting an enforceable contract. The bank is not present when the customer arranges the terms with the dealer. The lender, the indirect lender, is not present when the customer arranges the terms, and that creates challenges in the fair lending space, particularly for compliance purposes. I don't know, Bill, whether you want to add anything.
Oh, I definitely want to add a few things, Steve. The auto finance industry is very broad. It's like the old Oscar Mayer Wiener commercial. Big kids, tall kids, skinny kids, fat kids, even kids with chicken pox. I mean, we've got lenders of all sizes, of all types of charters, banks, credit unions, finance companies, captives, independents, and it's very fractured. And as I said in my statement, once you get below the top 30, and that's both bank and non-bank, you're getting into minuscule amounts of market share. And it's very different, and I think Chris mentioned in his comments, drawing on some history from the mortgage space and the problems we had there. In the mortgage space, it's largely driven by social policy, GSEs. You had a few large lending institutions that could, touching any one of them could move the market. The cards are dominated by the banks. There's no such domination that you see anywhere like that in the vehicle finance space. Second, it's transparent. Unlike in the mortgage space where you need to get an appraisal to figure out what your house is worth or the house you want to buy is worth, all you have to do is look in Paul's Kelly Blue Book on any vehicle and you know right away. I mean, this is not a mystery what the value of the asset that we're working with. Use cargo. I'm sorry, buddy. Wind me up and let me go. The vehicle finance market is unique in that it's, we have a large segment that are in this space that are state licensed finance companies, like a number of AFSA members, using their own capital and to create a market that's been around for 100 years. And it's been effectively regulated at the state level for 100 years. And I think I've told a number of my friends at the CFPB that one of the concerns that I continue to have, and this is not a fault, it's just a reality. Washington, D.C. is a bank-centric town. Finance companies is a new animal there. And I'm reminded that our friends at the Federal Reserve, so I won't hold you accountable for what the Federal Reserve said, but in 1920 in July, the Federal Reserve issued the following statement: do not finance automobiles for use for pleasure. If that were the case, no one here today would have come in a car. We would have all walked. So I would ask you to keep that in mind.
Thank you very much, Bill. Good morning, everyone. Thanks for everyone for coming. Crystal, my next question is for you, and what I would ask is specifically, what are you seeing in Indiana communities with regard to auto finance?
Thank you. Well, in the communities, I'm seeing a lot of people that are really right now. We're seeing a lot more auto loans, so I can't say that people are depressed that. They're just buying them for pleasure, but I can say that there is a need for autos. So right now, as far as community base, I think people are trying to get cars, and we haven't heard a lot of complaints on the high end, but on the low end, we know that people are still overtasked with what they're paying for automobiles. So, high interest rates.
Thank you. Paul, let me ask you a question. So Bill and Steve talked a little bit about the factors that differentiate the auto industry market. Can you talk about what unique challenges exist in the auto finance market for industry players?
Certainly, and actually just to supplement something that both Steve and Bill said, in terms of a distinguishing factor for this asset class, one should really look at how it compares to other asset classes. Look at asset-backed securities, look at delinquencies, look at defaults. It is exceedingly strong. It is exceedingly strong because it's based on a very strong underwriting model. They are not looking at speculation that the collateral will increase in value. They are looking primarily at the repayment ability of the borrower. So they're honed in on precisely the right factor, and the results are reflective of that fact. In terms of unique challenges, there are many. Certainly, what we're talking about here is one of them. It is a highly competitive marketplace, and that's a good thing. That's a healthy thing. That certainly benefits customers. It requires businesses that want to survive in that market to deliver superior customer service, to provide very competitively priced products, and to have a very strong efficiency of operations. On the compliance end, there are also challenges, and I think relevant to our discussion today, there's a couple of them that I would just flag very briefly. It's already been touched on, the whole issue of regulatory uncertainty. The Bureau has released a paper to weigh in on that area. That certainly is a concern when there are regulatory standards that are applied and you are not clear on what your compliance duties are. And one thing that in our own analysis of the paper we'll be taking a close look at is not just how it treats the issue of proxies. You know, are you putting customers in the right buckets for comparison purposes, but also are they similarly situated? Are you comparing apples to apples? Are you comparing somebody that received a subvened rate against somebody that received a non-subvened rate? In that situation, the dealer's compensation is going to vary, and it's not based on the customer's background. It's based on an independent business factor, in this case, the presence of a subvention program. Analytical controls are absolutely critical to looking at this issue, and we hope certainty is brought to bear on that topic. And finally, I would just talk about the issue of viability. It is extraordinarily important that one clear direction is provided, that that direction be viable. And one example I would hit on, and Bill talked about it a moment ago, is the whole notion that, and the Bureau has stated this repeatedly, that you can eliminate dealer discretion at the finance source level as a way to achieve compliance. The fact is that is not achievable. As long as dealers have multiple finance source partners who are competing with each other, you are not going to eliminate dealer discretion. You may shift the exercise of it, but whether it's on the buy rate, the wholesale buy rate, or it's on flat fees or anything else, as long as you have multiple finance sources competing for the dealer's business and the dealer is the one that decides who they send the paper to, you have an exercise of discretion. And in this arena, our hope is that the Bureau will focus its efforts not on the false hope that you can eliminate discretion, but on the real hope that you can manage it in a way that's very effective for consumers.
Great. Thank you, Paul. Chris, the next question is for you, and basically what we'd like to hear is, in your experience, what risks do consumers face in the auto finance market?
I think there's a significant number of risks that consumers face in this market. I think first and foremost, and this has been alluded to earlier, is that this is a complex transaction. You're talking about someone going in to buy a car, they have to negotiate the sale, they have to understand what they're buying, what goes into that. They may have a trade-in, and they have to understand what the value of that trade-in is, how the trade-in process works, and how to negotiate that. And then in the financing portion of it, you not only have the financing itself, but you also have a myriad of add-on products that are being offered to the consumer, many of which are complicated. If anyone's looked at a disclosure sheet for a extended warranty, for instance, you can see it goes pages and pages about exclusions and differences in what they cover. You almost need an advanced degree in automotive technology to be able to figure out what it all means. For consumers, it may be very difficult to compare, not only to figure out whether that particular warranty product is good for them, but also whether or not it compares to a warranty that's being sold by a different dealer, because the warranties will be different. That also leads to a lack of transparency. I mean, this is one of those cases where disclosure is great until disclosure is used as a shield. If you make the disclosure large enough, long enough, and complicated enough, eventually consumers really don't know what they're signing on to. They sign it anyway, and then it's used as a shield against them later when they try to raise issues about whether or not the product was suitable for what they had. because it was in there. It's disclosed in paragraph 7, subsection B, where it says that this particular part of the car is not covered under the warranty. We're concerned also with increases in loan-to-value ratios and longer loan terms. The average loan term now is 66 months. You've had 3 different representatives and manufacturers come out recently talking about concerns about stretching loan terms out farther and farther. We believe that this does 2 things. One is it masks affordability. Stretching out the loan term longer and longer doesn't necessarily make the loan affordable, just stretches out the loan term. It may make the monthly payment seem affordable, but over the long run it may not be. The second is that it can increase levels of negative equity. The longer you're in the car, the more likely you are to be underwater, particularly if you're talking about a long loan term coupled with a used car where the collateral may or may not exist over the life of the loan. You run the risk that the person's going to owe more on their car than it's worth, and there's always someone willing to help you wrap that negative equity into the loan. Finally, I just want to make one point, because this has been something that's popped up a lot, is comparing the delinquency and default rates in auto to mortgage lending. And comparing those rates side by side, we believe, is misleading for one important reason. It takes much longer to foreclose on a house than it does to repossess a car. On average, the foreclosure process lasts somewhere between 300 and 400 days. The average days to repossession is in the 40 days. The mortgage delinquency rates look high because there are a number of loans that stay on the books for a good long time and stay on the delinquency report for a long time. If banks were able to repossess a house in the way that they were able to repossess a car, delinquency rates and default rates would actually look much lower. So I think if we're going to be talking about an apples-to-apples comparison of those rates, looking at more than beyond just the point-in-time rate of the delinquency rate, but looking at cumulative rates would be an important thing to do as well.
Great. Thank you, Chris.
Thank you. I have a question for Crystal and for Steve. Some reports point to a recent uptick in extension of credit to borrowers with blemished credit histories. Have you observed this development? What are the potential risks and benefits of extending credit to this group of consumers? We'll start with Crystal and then Steve.
The increase of, could you repeat that?
The increase in extending credit to subprime borrowers with blemished credit.
Okay. We have seen that there's been a uprise in lending to people with a little less credit. We've seen that by the way that there's a lot more automobiles out there. There's a lot more people that are trying to obtain credit. But once again, we've seen those through the inner city car dealerships that also have a higher rate of lending. So we do have a lot more cars out there. But when people need a car, they go out and get a car, and they don't necessarily like to tell you their personal business of the fact that they've had to look at that through a higher lender. Also, we see that where they're getting a lot more used cars. So with the used cars, we know the interest rates are a bit higher as well, but there are a lot of people out there that are buying cars because they're in need of them.
Yeah, absolutely right. And I think there has been apparently an uptick in lending to people with damaged credit. My understanding is it's up from the trough in 2009, but it's not at the level it was pre-crisis. I believe you're absolutely right. People need to get cars, and the Brookings studies showed 90%, as you alluded to, of people say they need cars to get to work. Unfortunately, in our society, public transportation is not always as available as it ought to be for a lot of people. There are a good number of people with blemished credit, and they need access to credit. The wonderful thing about this market is that it is available to them. That's the good news. There is danger there too, and I think people with blemished credit have fewer choices in some cases. They're often based on either their location or simply their credit. And they have to be more careful maybe than others. But the opportunity is there. I think that the concern there is to prevent fraud, to protect them from deceptive practices, from steering, and that's critical in this place. But it's also important. Disclosures are important, and consumer literacy is important. I mean, I want to go to a point that you made, Chris. I mean, it's certainly true that disclosures can be too much, and at times, you can over-disclose, and people don't get much information because you've thrown too much at them. But it is also true that more and more things somehow you have to tell the consumer somehow. So that's the challenge. That's the tension there between the need to give them lots of information, whether it's legally or contractually or regulatorily, but at the same time, you don't want to over-disclose and create a problem, confuse the consumer, and create an opportunity for deceptive practices. So that's the tension that I think you have to deal with there.
Bill, I want to shift the conversation a little bit. We've been talking mostly about purchases of automobiles, but as Director Cordray indicates, there are indications of an uptick in auto leasing. So can you talk a little bit about how that leasing market and what trends and risks you're seeing in that market?
Thanks, David. Before I do that, if I could just make one quick comment with respect to the
And if we were to say no, and if we were to say no, what would happen?
I keep on going. You know me well, David. Anyway, I think it's important to at least state this. There may be an uptick in lending to subprime customers, but that's not necessarily a bad thing. We need to remember that credit is an opportunity, and what the uptick demonstrates is that lenders are willing to, following the crisis, based on performance, go deeper to help folks that need access to transportation to get to jobs. And I've mentioned this to Steve before. Nobody would question extensions of credit to somebody that's carrying around a black Amex card. But in the subprime space, we don't have any problem talking about wanting to, ratchet back because they might be taken advantage of. At the same time, you're the regulators. You need to be diligent to make sure that they're treated fairly, but we do need to remember that we're a credit economy going all the way back to before our country was founded. And credit is a good thing. It helps people, build wealth, get jobs, and we can't lose sight of that. So I'll get off my soapbox. With respect to leasing, I think it's just one more way of offering consumers choices of how they want to finance a vehicle. It reflects, I said at the outset with respect to the Oscar Myers commercial, consumers are exactly the same. You have consumers that have all sorts of different needs and desires in terms of what they want. I work with plenty of folks that want a brand new car every 2 or 3 years. They want the new technology. Leasing makes a lot of sense. I've got 2 kids in college, so I'm driving around in a 10-year-old car that's been paid off. I mean, it's different needs and wants. So I do think that it's an important thing. I think that the increase in leasing means that the economy is growing in strength. With respect to risk to the consumer, I think it actually removes a risk to the consumer because the finance source actually bears the residual value risk of the car that the consumer is turning in at the end of the contract.
Great. So thank you, Bill. I'll also note I also drive a 10-year-old paid-off car.
I knew I liked you.
Also that, I just want to clarify as well that I think the Bureau would be quite supportive of an expansion of responsible subprime credit, just also being mindful of the increased risks to underwriting and other factors that exist in that marketplace as well. So with that, let me go back to Andrew, and more broadly back on the auto financing side. What I would ask Andrew is, more broadly, what impact does auto financing have on other aspects of consumers' lives in your experience?
Thank you, Steve. It has a tremendous impact, and before you get to that impact, that impact is multiplied by many times if it's a poor loan. If it's either high interest or it contains markups or warranties that weren't necessarily desired. And I just wanted to say respectfully to the gentleman, while I'm sure that it is the point of the goal of dealers to provide superior customer service, we can't ignore that. Of course, the point is also to maximize profit margins. And when those contracts, those lending contracts are sold, be they good or bad ones, and particularly the bad ones, the dealer has no incentive to write necessarily a safe loan. And when it does happen, a bad loan is written, a bad auto loan, then cash is gone, usually for most consumers. And in the case of repossession, they can have a lowered earning capacity based on lack of transportation and consequential damages. I'm an attorney, such as student loan liability or things that happen because their car was repossessed, because they couldn't afford the loan, or because they wanted to put in some things that weren't necessarily agreed upon. Bankruptcy is always an option and a necessity at times when the loan cannot be repaid, in overall living conditions and utility shutoffs. But I think worse credit than when they came into the dealership is also a major financial obstacle because of the many credit pulls, and also because of maybe the high loan that they later defaulted on because they couldn't afford it in the first place. Thank you.
Thank you, Andrew. I'll just note that I drive a 13-year-old paid-off car and am also using it to teach my high school senior to drive. Moment of silence.
Sorry to hear that.
Yeah, yes, indeed. I have a final question for all the panelists, starting with Steve. What information do consumers need to make informed choices about auto financing?
I thought I was going to get the last word again.
No, this time Chris will get the last
All
word.
right, I'm in trouble now.
Balance.
All right, thanks, Patrice, for that question. I mean, I think that's goes a little bit to the point I was talking about before. You know, consumers have the truth in lending disclosures, obviously, so they have the APR. The APR is supposed to be a sort of one piece of information, one rate that you can use to shop for credit. That was the original concept from the Truth in Lending Act. It was to keep it simple, in a sense, and to get past that complexity of rates and financing charges and the like. But that's simply one factor in an indirect auto loan transaction. And the challenge there is that the consumer has to be aware of the other factors. The main thing is that consumers are in a position where they have to negotiate terms. And I think it would be very critical for consumers to have a good, firm understanding that they can negotiate the terms and that they have the information they need on which to make those decisions. I'm hoping that the internet might help in that process as well. And I think that as consumers gain more understanding of that, they should become better consumers and get better terms in the transaction.
Yeah, I would echo Steve's observations. Certainly, and I think this is an area where we have agreement with Chris on this point, simplicity in this arena certainly is preferred, and as Steve was alluding to, the Federal Reserve Board, in implementing the Truth in Lending Act and putting out Reg Z, that is precisely what they did. They really came down to some core, highly relevant terms that consumers needed when they execute a credit contract to be able to understand the cost of credit and engage in cost comparison shopping. And we're all familiar with what those are. They are the APR and the finance charge and so forth. So fortunately, they've looked at that issue, and they also concluded in doing so that the APR is really the single most relevant single most relevant figure for cost comparison purposes. When you look at that, you are in the best position. You are comparing a retail price from one offerer to a retail price from another offerer, and you get the best idea of how it stacks up relative to the other offer. In addition to the Truth in Lending Act disclosures, though, I think all of us collectively, government, industry, consumer groups, all of us together have an interest in promoting financial literacy. And there have actually been some phenomenal efforts in that regard that have really advanced that objective forward, and we think more can be done and should be done, and we're eagerly pursuing those opportunities. Let me just talk about a couple tools. Of course, I think many of us are familiar with what the Federal Reserve Board put out years ago, Keys to Vehicle Leasing. They coordinated with numerous groups, including NADA, to try to provide consumers with a very simple pamphlet that would lay out exactly what leasing is. More recently, the AFSA Educational Foundation and the National Auto Dealers Association, in cooperation with the FTC, issued a brochure called Understanding Vehicle Financing. And this also spells out very important terms, and it's something that's very well regarded. Now, I will tell you, both Chris's members and our members and Steve's members, we're all involved in these different efforts to get out information. One of the efforts in this regard is the AWARE Coalition. And this is something that the website for it is autofinancing101.org. But the whole idea is to offer consumers a suite of products to help them understand this process. And without going through what all those products are, clearly we don't have the time for that. I'd like to just hone in your attention on one that we think is particularly effective. When we talk about consumer education, the concern is always you have to give it to a consumer in a form they can understand and digest and something they'll actually read. And so being succinct, being concise, being clear obviously is critically important. One of the tools that the AWARE Coalition produced is something called the wallet card. And as the name suggests, it is something that fits inside a wallet. And really, it gives 4 things to do before going to the dealership, 4 things to do while visiting the dealership. Again, this is all in the interest of simplicity and promoting understanding. Without going through each of them, one of them, in terms of things to do before going to the dealership, is to compare annual percentage rates, that's the APR, from other sources such as banks, finance companies, and credit unions. Now, I'm not sure how many industry players are in the habit of telling consumers to go first to their competition, but that's precisely what is recommended here. On the other side, when they're actually visiting the dealer, several things, but one of them is what was already mentioned by Steve, negotiate your finance arrangements and terms. So we think that there are great opportunities to put highly relevant information into the hands of consumers and certainly enhance their understanding of key terms when they make a purchasing decision.
There may not be a lot I can add to what my colleagues have said, but I'll name 2 things that consumers can do. One, to put it more succinctly than what Steve and Paul have said, is shop. Check out different funding sources, check out different dealerships. That's the first thing you can do. And the most important thing you can do, and hopefully it addresses some of the concerns that my friends at the other end of the table have raised, is if you don't understand something that's been put in front of you in terms of the transaction, don't sign it. It's that simple. The car will be there tomorrow. Paul's members will have plenty of cars there later on that week. If you don't understand it, don't sign it.
Thank you.
Thank you. I think consumers need a lot of information. Some of the most important things is that you don't have to take the dealers. You don't have to take dealer financing. I'm not even sure that a lot of consumers know that. They feel like they go to a dealership and that that there's other ways to get financing. I think they need to know that if they do opt for dealer financing, their credit's going to be pulled for 10 to 20 times, and that could lower their credit score. And I think the education about needing to shop is very important, although it is a very difficult environment because that's the dealer's whole point is to stop your shopping so you can buy with them. Yeah, yeah, I think that's true, that you do have the option to shop and that you should shop and not become captive to whatever situation you are, and to make an informed decision to not sign anything that you don't have to sign, which of course you don't. That's it.
I think one thing that would be very helpful when we talk about education, that there would be some type of advocate when somebody goes to shop for a car, that they know once that they don't understand a contract or something completely, that there's an advocate there to break it down in layman terms for them. You have a lot of people that are desperate at that point when they go to buy an automobile. And if they do not already do any type of banking, then they don't know anything about other financial institutions. So the best thing to do is to try to find a network that they could even go through, community-based organizations, to help them through some of these processes as far as forms and things like that, and really know what it is when they see the different acronyms and things like that, to explain that to them, because a lot of us know that, but when you look at the community as a whole, there's a lot of those things that they don't know within contracts, so they're not familiar with what they're doing, or all they know is that we've bought cars from this particular dealership through a generation, so that's what I'm going to do, even though it's not conducive for me. So I just think there's a lot of education that needs to be out there for people to understand when it comes to long-term and different contracts that they'll be trying to sign.
Yeah, I think one of the fundamental difficulties in all this is that the person sitting across the desk from the consumer is always going to know more than the consumer does. It's because it's their job. The salesperson knows more about what's going on than the consumer will. The finance manager will generally know more than the consumer will, because those folks are going to do more deals probably in one day than a lot of consumers are going to do in a lifetime. So expecting consumers to develop expertise on par with the person sitting across the table is a fruitless exercise. I think unless you have strong rules and you have protections for consumers, consumer education is pretty well meaningless. Take one example of a survey that we did around dealer markup, and one of the pieces of advice that people are normally given is that you should try to negotiate your interest rate. Well, we found that African American and Latino consumers were more likely to report that they tried to negotiate their rate, and they still received higher rates than whites. Further, in financing, the only way to find out the loan terms that you would qualify for is to actually go through the whole process. And in many cases, if you want to go through a deal, you have to negotiate the car, negotiate the trade-in, negotiate all these other things, and then you can get to the financing part, and then you can find out what the price is. That's great if you've got time. And if you're a single mom who's working a couple jobs, who's got to take time off of work, asking them to go to 3 or 4 dealerships and go through that process over and over again is asking an awful lot of those consumers. So I think while consumer education is important, and certainly we want consumers to know what they're getting into, I think it's asking a lot of them. The other thing our survey found was that African American and Latino buyers were more likely to report being told information that led them to believe that the financing rate that they were offered was the best rate available or the best rate out in the marketplace. It's very easy for someone who wants to sell somebody into something that they probably shouldn't get otherwise to negate what they know. Because ultimately, people are trusting. People trust the person that they're talking to. They want to believe that that person is telling them the truth, even though in a lot of cases that may not be the case. And finally, even if you ask them to find information, a lot of that information isn't available. Again, with dealer markup, for instance, the only way for a consumer to protect themselves, again, is to go through and get multiple financing offers. But even then, you're asking them to compete, to negotiate the markup, but they don't know how much the markup is. The rate is the rate. So what are you negotiating against? And there's no way for consumers to know on an objective level. I can't go to my neighbor and compare the 2 financing offers we got and know whether or not those 2 were actually the same. Did we pay the same markup at the same dealer? I have no idea, because the financing is personal. They're basing it on my risk. There's a risk portion and a compensation portion, and there's no way for an average consumer to be able to divide the 2.
Let me thank all of our panelists again as we transition to the audience testimony portion. Thank you.
At this time, will the guest panelists please rejoin the audience, and please join me in thanking our guest panelists. An important part of how the Bureau helps consumer finance markets work across the U.S. is to hear directly from consumers, from industry, from community advocates, and from many others. One of the ways that the Bureau gathers public feedback is through public events such as these, We've had field hearings, public town halls, and other public events in places like Philadelphia, Pennsylvania, Minneapolis, Minnesota, Birmingham, Alabama, Sioux Falls, South Dakota, Durham, North Carolina, Detroit, St. Louis, Missouri, Des Moines, Iowa, Itta, Mississippi, and of course now Indianapolis, Indiana, among many others. At these events, we not only hear from experts in the field, we also invite the public to participate and share their comments as well. Before I open the floor for comments, I want to remind folks that there are several ways to communicate your observations, your concerns, or your complaints to the CFPB. You can file a consumer complaint with the CFPB through our website at consumerfinance.gov. Our website will walk you step by step through that process. If you don't have a specific consumer complaint but would like to share your story, we have a feature on our website called Tell Us Your Story, where you can tell us your story, good or bad, about your experience with consumer financial products. Your story will help inform the work that we do to protect consumers and to create a fair marketplace. We also have another feature, Ask CFPB, where you can find answers to over 100 frequently asked questions about consumer financial issues, as well as additional resources. I encourage you to visit consumerfinance.gov to learn more about the resources and tools that the Bureau has developed to help consumers make the best decisions for themselves and for their family. Now it's time to hear from you. A number of you signed up to share comments and observations about today's discussion. The open mic portion of the field hearing is also an important opportunity to the Consumer Bureau to learn about what's happening in consumer finance markets in your community. Each person who signed up to provide testimony will have 2 minutes to do so. And what we hear from you is invaluable. We want to hear from as many of you as possible, so I encourage you to please observe the 2-minute limit so that as many folks as signed up to share their observations have the opportunity to do so. Our first audience participant is Andy Koblentz. Someone will bring a mic to you, Mr. Koblentz.
Well, thank you very much, and thank you for the opportunity to speak. I'm Andy Koblentz with the National Automobile Dealers Association. And I just, as the Bureau goes forward, I just encourage it on a couple of things. One, you want to make sure that you have accurate information about the marketplace. There was a comment earlier that when you pull credit reports, when you go to a dealer and pull multiple credit reports, that adversely, because you're going to many finance sources, that adversely affects your credit score. I don't believe that's accurate. I think that if those reports are done as part of one transaction, that has the same effect. So I'd encourage you to make sure that the information you're getting is accurate. I also want to take a page out of the director's comments and to encourage the common sense approach. That is the right, and let's think about how the markets work. And another comment was made was that the dealers have no incentive to write a good loan. I believe that was the statement. But the dealers are operating in an intensely competitive marketplace, and they want to keep a customer for life. People need cars throughout their lifetime. They need service. The dealers have an ongoing business, and satisfying their customer and treating them fairly is an enormously powerful incentive. And the dealers have a tremendous incentive to take care of their customers and treat them right, because that person will not only not go back to the dealer if they're treated poorly, they're going to tell their neighbor and their friends, and that dealer's reputation will go totally down. So
Thank you, Mr. Koblentz.
Oh, I'm sorry. Thank you.
Damon Lester.
Thank you. Damon Lester, I'm president of the National Association of Minority Automobile Dealers. Just a couple of things that I've just heard today. One, thank you for issuing out your reports, and we've been asking for a while for your documents. So that's, haven't had a chance to take a look at all of them. Man, you really put a lot out there. But we just want to, thank you for that. And I guess one thing, we all need to have a responsibility to make sure no consumer has an anxious or uncomfortable feeling when they're purchasing a vehicle. Okay, we've heard things about disclosures, and we're probably overly disclosed with, particularly in that F&I contract process. I think Chris mentioned that it was, it was too long to buy a vehicle, the process, but if it was too short, we'll be back here next week to have it while the process is too short. So I think that we have a responsibility to protect Mr. and Mrs. Customer, no matter what age, race, or ethnicity. For our standpoint, I think what we are doing on our dealer side is trying to protect the consumer, to make the process as fair and transparent as possible as it relates to the compliance program that we've adopted and that we're urging all of our dealers to take heed to. We just need your help to help us help you to make sure that all the consumers are being protected. That's my comment.
Thank you, Mr. Lester. Robert Duff.
Thank you. Excuse me. I'm an Indiana consumer lawyer. I practice here in Indiana. I represent consumers. That's all I do. And I take a lot of calls from consumers. And I want to talk very briefly. The panel ended with the discussion, what information do consumers need? There were mention about the Truth in Lending Act disclosures, the ability to negotiate, shop around. Let me tell you one of the things that I've seen kind of on the ground level that makes those things completely not work. And that is the concept of yo-yo financing. The dealers call it spot delivery. But essentially what happens is a consumer comes in, negotiates the deal, completes the deal, thinks that they have purchased a car, and they leave with the keys to that car. This car is theirs. It is completed. What they don't know is that that deal is only completed for them. It's not completed for the dealerships. And the dealership later calls them 3 days and says, you know what, we've had trouble with the financing of your vehicle, and we're going to need you to come back in and sign some more paperwork. And typically what that means is that the dealer, either the dealer planned it, sometimes they completely plan those in my belief. Other times they run into problems selling the retail installment contract. They don't have the employment paperwork that they needed, or they're not able to get as much for that retail installment contract as they think that they should. But the problem is that for them, it's not a completed contract. They just call the consumer back in, and the consumer at that point essentially only has the option to come back in, and now the consumer's had the vehicle for a while. So it's like somebody that sends a kid at the pet store home with the puppy dog. And now they've fallen in love with this car, and they've had it, and they showed it to their friends. And it would be really embarrassing if they had to give this up. So what happens is that they end up in worse terms with a subsequent contract with the dealership. And the original Truth in Lending Act disclosures meant nothing, because now they're in a subsequent deal with new terms. And I take calls from consumers about auto fraud and auto issues. And at the peak, I bet I was getting one call a day of a person who was either had experienced this or was in the process of going through this. This is a problem that I think, and I know that the CFPB does not regulate directly dealers, but I also believe that if you regulate the lenders, that the paper that they buy, you can have a huge impact on that happening to consumers.
Thank you, Mr. Duff. Linda Elkins.
Hello, I'm Linda Elkins, Chair of the Economic Dignity Team for the Indianapolis Congregation Action Network, the local PICO affiliate for the greater Indianapolis metropolitan area. One of the things that we are hearing, we speak to people throughout the community, and we do hear continuously about these kind of loans that have landed the families in economic hardships. And I realize that the Bureau has limitations on your reach, but many times it is not the large manufacturer dealerships that are causing the issues. It's the small dealerships with used car lots that the families are most often turning to and having in these yo-yo deals. We hear about that, or they've got the car and it doesn't run the next day and they have the same kind of issues. Come back, we'll take care of that. That it's not information that they have at their hands and they have no recourse. They see no way to take care of it themselves.
Thank you, Ms. Elkins. Marty Murphy.
Thank you. My name is Marty Murphy. I'm the director of the Automobile Dealers Association of Indiana. I want to underscore the commitment that franchise auto dealers here in Indiana and across the country have made to ensuring that their customers have access to the tools necessary to be financially literate and understand the auto financing marketplace. We've heard a lot today about just how competitive the auto industry is. The other piece of the puzzle is to ensure that consumers know how to leverage all that competition to their benefit. And dealers are helping to lead the way in completing that mission. Our industry makes great efforts to enhance consumer understanding of vehicle financing and to make available useful resources to support this process. For example, the Coalition of Americans Well-Informed on Automobile Retailing Economics, or AWARE, which was jointly established by dealers and lenders, hosts a website at autofinancing101.org that provides consumers with a wide range of information on specific vehicle financing and leasing topics. Materials found there include a comprehensive teaching kit entitled The Auto Financing Roadmap, a guide for teaching auto financing in your community, a brochure entitled What You Need to Know About Auto Financing, and an auto financing wallet card, which you heard about earlier, a series of articles on topics such as credit reports and negotiating vehicle financing. These and other resources can be found at AWARE's Auto Financing 101 Learning Suite, which also includes the highly regarded brochure entitled Understanding Vehicle Financing, which was prepared by the AFSA Educational Foundation and NADA in cooperation with the Federal Trade Commission, as well as the Federal Reserve Board's Keys to Vehicle Leasing.
Thank you, Mr. Murphy. Barbara Bowling Williams.
Actually, Attorney Duff already raised the question that I was going to raise, the issue with consumers purchasing or at least signing all the documents in the dealership, and then only to find out a few days later that they've got to come back in. So thank you for that.
Thank you, Ms. Bowling Williams. Ron Smith.
Thank you. My name is Ron Smith. I'm an attorney in Indianapolis. I've been practicing law for 46 years now, and probably 45 years of those have been representing dealers. My client base has been several hundred dealers over the Midwest, Southeast, and Northeast. I have been representing the Automobile Dealers Association of Indiana for a good number of years. A lot of what we do is compliance work. We conduct seminars annually. We write brochures. We write bulletins. We write newsletters that go into automotive finance compliance, as well as other compliance issues. And we've been doing that annually for a number of years. It has been my experience that, of course, the most new car dealers or franchise dealers are very, very compliance oriented. They go to great pains, great expense to get what the information they can get about compliance. Also, I believe that the vast majority of loans originated by franchise dealers go through without a hitch, without any consumer problems. Thank you.
Thank you, Mr. Smith. Andy Frazier.
Andy Frazier with the Indiana Association for Community Economic Development. We're a statewide association of 200 community-based organizations that support low-income families with doing the work of resilient families in vibrant communities. I want to commend the Bureau for having the hearing. Very much appreciated. Want to point you to some of the research that the Center for Responsible Lending has done specific to the Indiana context, which says $456 million of impact for low-income Hoosier families and Hoosier families as a result of dealer markups are having an adverse impact on the ability of families to get economically ahead, if you will. We've heard a lot today about the importance of financial literacy and consumer education. I'd also encourage that we think of that work not only in our own silos of the work of the industry or the work of federal government or of community-based organizations, but how we might work together collaboratively. IECED represents a diversity of interest, and it was said earlier that credit is an opportunity. It is both an opportunity for economic advancement, but it is also an opportunity for exploitation. And so to the extent that as the industry, as financiers, we can come alongside community-based organizations who are on the front lines doing this work, working with low-income families, working with Hoosiers, I think we can build a stronger financial literacy capacity. Many of our regulated depository institutions do that already through the Community Reinvestment Act and the way that they think about how they support communities. I would encourage, as we think about other types of finance, we encourage that same type of collaboration that tries to bring industry and advancement and profit motivation in line with community advancement, building resilient families and vibrant communities. Thanks for the opportunity.
Thank you, Mr. Frazier. David Ogden.
Thank you very much. Thanks for the opportunity to address the leadership of the Bureau, the very distinguished leadership, and for the chance to hear from so many others, including advocates for consumers, so they're interesting and important information. I'm here representing the National Automobile Dealers Association, and I want to talk just for the 2 minutes I have about the fair lending issues that the Bureau is looking at. And I agree entirely with Director Cordray when you say that discrimination hurts us all. It's wrong. It's economically inefficient. And as you note in your supervisory highlights that you've just released, fair lending concerns about discretionary pricing is centered on the possibility of unexplained disparities on a prohibited basis, where there's an absence of a legitimate, non-discriminatory, documented reason for it. That's what you say, and that's what the concern is. But it's also important when you're thinking about what's right and wrong and what's efficient and inefficient to remember that flexibility has virtues, and among them specifically is that the retail price of a loan can be lowered to meet competition. And that kind of competitive pressure is important to consumers, and it's important to the economy. Flat rates don't allow for that kind of price competition. But what does allow for it is NADA's Fair Lending Compliance Program, which would impose what you call, this isn't your characterization of the NADA program, but it's what you advocate for dealers, strong fair lending compliance management systems. That's what that program is, because it requires a documented, legitimate, non-discriminatory basis for any difference. That's what that program is designed to do. It negates the risk of discretionary pricing. It's based on a DOJ consent decree, only it's tougher the way it's been designed. So I would just urge you, I think it's really key for federal regulators here to incentivize broad adoption of that program, which touches consumers directly at the retail point, which will ensure that there are legitimate, non-discriminatory reasons for any differences and allow price competition to take place. Thank you.
Thank you, Mr. Ogden. Kim Boyd.
Again, to repeat everyone's appreciation that it's been expressed here today to Director Cordray and all of the panel who came out today. It's just been valuable information and good dialogue all the way around the board. To try to keep my 2 minutes, I definitely want to point out, as well as the other gentleman that just made his commentary before me, I think it was Bill on the panel that made a statement about credit is an opportunity. It definitely is an opportunity, but the question becomes, is the opportunity to be predatory to consumers, or is the opportunity to advance a person's quality of life for their family? You know, in cases like Wells Fargo, Countrywide, definitely there were some predatory practices there. So the question becomes, where is that credit opportunity directed? The other thing is, I heard on the panel shop. and have a grocery list. But for the consumers that are typically shopping for these automobiles, can't even understand the terminology. There's a lot of consumers that don't understand subprime. I remember when I first bought my first car, there was no such thing as gap insurance. Gap insurance has come about. So again, when you talk about the automobile industry, and they make the statements that they have these services that are available for consumers, my question is, number one, some of these consumers don't even have the internet, which is why they're getting subprime rates. Number two, what are you doing to engage with the community that is outside of the scope of their respective interest groups, lobby groups, and actually getting to that consumer that needs the most help and is getting hit the hardest by these subprime rates? Because they go to a car shop or dealership and they don't understand the terminology. It's quite over their head. So then let's see some investment by those automobile dealers within the community to go grassroots, actually touch those consumers so that everyone has a free opportunity, whether accessible to the internet or not.
Thank you, Ms. Boyd, and I encourage you to share your contact information with Chris Vaith so that he can talk to you about how we can do a better job of reaching the communities that you described. Judith Fox.
Hi, I'm Judy Fox. I'm a professor at Notre Dame Law School, and I run the Economic Justice Clinic, which is a free clinic for consumers in Indiana. Just briefly want to echo what Mr. Duff said. We see yo-yo loans, but that's not really what I wanted to talk about. I've just started a study of the credit practices of low-income Hoosier residents, and having pulled and looked at well over 100 credit reports this summer and talked to consumers, I can tell you, well, I don't have my study done, that consumers do not understand loan financing. And I'm not going to say that I understand the FICO credit scoring completely, but I will say that all of the credit bureaus at least report on their credit bureaus that all of those inquiries when you went into a car loan count against your credit. So perhaps the credit bureaus are incorrect, but they do at least come out on the credit report as counting against your credit. I wasn't going to speak today, but the last question that was asked to the panel, I just couldn't resist. I became a lawyer because before I was a lawyer, I bought loan paper from dealers. And we used to have a game in our office when we looked at the interest rate that came in to guess the race and ethnicity and sex of the buyer. And we were never wrong. If it was over 20%, it was an African-American woman. If it was 7%, it was a white male. That's why I became a lawyer. And if you want to know what consumers need to know, when they go into a dealer, they think they're going in just as they used to think they're going into a loan broker, to somebody who's doing the best to get them the cheapest rate. They need to know who their loan was shopped to, what rates they were offered, what rates you're giving. Dealers need to make money, and I understand that, but the consumer needs to know that I could have gotten a 7% loan from First Source Bank, but you're going to give it to me for 12%. And I'm going to give you the 12% loan, and because of that, I may be reducing the price of the car. That might be fine, but that's what the consumer needs to know. They need to know where those deals were shopped and what rates were offered.
Thank you, Ms. Fox. And thank you to everyone who provided thoughtful comments today. Thank you to the audience, to the panelists, and to all those who are watching via live stream at consumerfinance.gov. Thank you to IUPUI for hosting the CFPB. This concludes the Consumer Finance Bureau's field hearing in Indianapolis, Indiana. Have a great afternoon.